Dear students, welcome to Digital Learning. Today we will solve one more problem from the chapter Holding Company Accounts. This is a question from Mangalore University M.Com question paper. The problem is given here in the screen. See the balance sheet, the following are the balance sheets of H Limited and its subsidiary S Limited. Balance sheet as on 31st March 2016, H Limited, S Limited. Share capital, there are two types of share capital, 6% preference shares of rupees 100 each, 1,60,000. Means 1,60,000 divided by 100, that is 16,000 preference shares of 100 each. Equity shares of rupees 10 each, 6 lakh H Limited, S Limited 2 lakh. 2 lakh, it means 2 lakh rupees divided by 10, that is 20,000 shares of 10 each. General reserve, profit and loss account, 6% debentures. Proposed dividend on equity shares and preference shares. Outstanding interest accrued, 2,400. Sundry creditors, these are the items on the liability side. Asset side, you have fixed assets. Then there are three types of investments. Three types of investments are 15,000 equity shares in S Limited, that is holding company's investment in subsidiary company. H Limited is holding company, S Limited is subsidiary company. 3,30,000 is equity shares, 1,200 preference shares in S Limited, 1,20,000, 1,000 6% debentures in S Limited, 10,000, and current assets. So here 15,000 equity shares in S Limited. It means it can be explained as, see here, majority share 15,000 out of 20,000 means 3 by 4. Minority share remaining 15,000 minus 20,000 minus 15,000, 5,000. Out of the 20,000 is the out of 20,000, 5,000 is the minority share. So 3 by 4 majority share, 1 by 4 minority share. Now we will look at the adjustments. The general reserve of S Limited as on 31/3/2015 was 80,000. Here 31/3/2015 means last year's end, means it is current year's beginning. So at the beginning of the year, you had general reserve 80,000. H Limited acquired shares in S Limited. Holding company acquired shares in subsidiary company on 31/3/2015. It means at the beginning of the current year it acquired. It means the current year is post-acquisition, and beginning of the current year or the dates before the beginning of the current year is pre-acquisition. So as the acquisition date is 31/3/2015, this general reserve of 80,000 is fully pre-acquisition reserve. Then balance of profit and loss account of S Limited is made up as follows. Balance as on 31/3/2015, 56,000. This is the opening balance of profit and loss account, which is purely pre-acquisition. Net profit for the year ended 31/3/2016, 63,600. This is current year profit, which is purely post-acquisition. Total 1,19,600. Out of that, you are deducting the provision for proposed dividend, 29,600. So it is explained now. See date of acquisition, 31/3/2015, which I have explained. That is end of the last year and beginning of the current year. So the current year profit and current year reserve are post-acquisition reserve and post-acquisition profit, which is both of them are of revenue nature, revenue profit, revenue reserve. Profit at the beginning of the year, as I told from the problem, 56,000, which is pre-acquisition profit, which is a capital profit. Profit for the current year 63,600, which is a post-acquisition profit, revenue, which is a revenue profit. This is what we have explained. These 3 points are relating to the these 2 points are relating to the third adjustment. Now balance of profit and loss account of S Limited as on 31/3/2015 is after providing for preference dividend of 9,600 and proposed equity dividend of 10,000, both of which were subsequently paid and credited to profit and loss account. So we have preference dividend and equity dividend, which is treated like this here. preference dividend and equity dividend. The majority share in the dividend for 2015 on both preference and equity share, which is given in the adjustment which I read just now, is deducted in the calculation of cost of control. Means 10,000 into 3 by 4 and 9,600 into 3 by 4, which is 7,500 and 7,200. Total 14,700 is the majority share in the dividend for 2015 last year, which is given in the adjustment, that is this adjustment number 4. Okay, its majority share is deducted while calculating the cost of control. Then later on, next point, S Limited, no entry have been made in the books of H Limited for the debenture interest due or proposed dividend of S Limited for the year 31/3/2016. That we have to make the treatment now. S Limited has issued fully paid bonus share of 40,000 on 31/3/2016 among the existing shareholders by drawing upon general reserve. Transaction has not been given effect to in the books of X Limited. So this is the case of bonus share, 40,000 bonus share. So what to do about the bonus share? We have to split it into minority share interest and majority interest. See here. First of all, let us discuss about the debenture interest I just explained. Majority share in the debenture interest. This is the difference. This is the point in fifth adjustment. And here in the balance sheet, it is given debenture interest outstanding 2,400. Or we can also calculate debentures 40,000 into 6%, 2,400. Okay, its majority share, its minority share. So majority share in debenture interest outstanding, that is 2,400 into 3 by 4 or 40,000 into 6% into 3 by 4. Both are same. 1,800 rupees should be added to the debentures in the balance sheet. And its minority share, that is 40,000 into 6% or 2,400 into 1 by 4. 600 should be added to the profit and loss account, which also go directly to the balance sheet later on. Then now let us look at the bonus share of 40,000. So bonus share of 40,000, there are three treatments. First of all, it should be deducted from the general reserve, that is capital reserve or capital profits, pre-acquisition reserve. Here in the solution we have written as capital profit or capital reserve. Then its majority share, 40,000 into 3 by 4, should be deducted from cost of control, and its minority share should be added to the minority interest. These are the basic explanation I have given. Now let us go to the calculations. See, analysis of the profit and loss account. This capital profit means pre-acquisition profit, revenue profit means post-acquisition profit. Both profit and reserve are taken together here. See, general reserve on 31/3/2015 opening, that is 80,000 given in the balance sheet. Adjustment also it is mentioned, date. Profit and loss account on 31/3/2015, that is beginning of the year, 56,000. These both are pre-acquisition because date of acquisition is 31/3/2015. On that date, this balance, that is pre-acquisition. Then profit for the current year, that is year ending 31/3/2016, that is current year profit, means current year beginning is pre-acquisition date, acquisition date. The date before the current year beginning is pre-acquisition. So current year, the full current year is post-acquisition. So current year profit is post-acquisition revenue profit. So 1,36,000 and 63,600. Now from this capital profit, you have to deduct the bonus shares, 40,000. Balance is 96,000. Now we have to split this 96,000, capital profit of 96,000 and revenue profit of 63,600. Both should be split into minority and majority. Minority interest 1 by 4. 96,000 into 1 by 4 is 24,000. 96,000 into 3 by 4 is 72,000. Now 63,600 into 1 by 4 is 15,900. And 63,600 into 3 by 4 is 47,700. So these are the majority share and minority share. Okay, majority share is capital. So the capital profit should be will go to the cost of control. Revenue profit will go to the balance sheet through the profit and loss account. Then bonus share, this 40,000, it should be treated here. As I told, it's 3 by 4, 30,000. It's 1 by 4 is 10,000. Its treatment is already explained. Now cost of control or goodwill. See, cost of control formula is cost of investment minus paid up value. And if there is any capital profit, it should be adjusted. So cost of shares acquired, it is given in the balance sheet from holding company. That is this 3,30,000 asset side, you see. I'll show see the cursor point, 3,30,000, 1,20,000. This is the what we say uh, cost of investment, 3,30,000, 1,20,000. It is 15,000 equity share of 10 each. This is 1,200 equity shares of 10 each. Sorry, 15,000 equity shares of 10 each, 1,200 preference shares of 100 each. So that amount is also required. So this one for 3,30,000 and 1,20,000 is added here. 3,30,000 cost of investment, sorry, cost of investment here, see, 3,30,000, 1,20,000. 4,50,000 is the total cost of the shares acquired, cost of investment. From this, as I told already, dividend for 2005, I have explained in the second slide, that is 10,000 into 3 by 4, 9,600 into 3 by 4, 7,500 and 7,200. This I have explained here. See, this 14,700. So this should be deducted from here. Then for you get 4,35,300. From this 4,35,300, now we have to deduct the paid up value of the shares acquired. As I told already, this is given here. See, this one, 15,000 shares into 10, 1,200 shares into 100. So that comes 1,50,000, 1,20,000. Then share of the capital profit. In the last slide you have, this is the share of capital profit, holding company share, 72,000. Okay. Then bonus share in the bonus share, 3 by 4, 30,000. So this 72,000, 30,000. So all these four amounts should be deducted. This is deducted from this 4,35,300 minus 3,72,000. It comes to 63,300. So cost of control, it is 4,35,300 minus 3,72,000. So investment is more than paid up value. So it is a goodwill. Now minority interest. This is share capital, minority interest in share capital, that is 2 lakh into 1 by 4, equity share only. Next, minority share in bonus share, that is equity, bonus share is equity, 10,000. As I explained here, this 10,000, this 10,000, 40,000 into 1 by 4. Then preference share capital, that is 1,60,000 into 1 by 4. We can get it from the 1,60,000 into 1 by 4. That is preference share capital. See here, it is here. 1,20,000 into, sorry, this one, 1,60,000. This is 2 lakh. 2 lakh into 1 by 4. 1,60,000 into 1 by 4. That is what we have written here. Okay. 10,000, 50,000, 10,000, 40,000. Then share of capital profit, share of revenue profit. That is minority share. In the last slide we have here. Share of the minority share in capital profit, 24,000. Minority share in revenue profit, 15,900. So 24,000, 15,900. Total 1,39,900. These are the calculations we have completed. Now we will move to the balance sheet in the new format as per Companies Act 2013. Just check the balance sheet given in the problem. Shareholders fund, share capital. We write only holding company's share capital. Equity shares of rupees 10 is 6 lakh as given in the balance sheet. Same amount, only holding company, that is H Limited's share. Then reserves and surplus, that is general reserve of H Limited 1 lakh. Then profit and loss account of H Limited 2 lakh. To that, debenture interest 600 should be added. As I told already, debenture interest 10,000 into 6%. So that is in mutual intercompany owings, 10,000 into 6%. So then profit from S Limited, that is note number 1. See here, note number 1. This 47,700. This amount will go. This is post acquisition profit or revenue profit, which goes to the balance sheet. 47,700. Total 2,83,300. Then I explained in the second slide already. Dividend from S Limited received 14,700. This is given here, 14,700. This 14,700 dividend from S Limited, this one, or we have explained here, this 14,700. This should be also deducted from here. Then you will get 2,33,600. 1 lakh general reserve, profit and loss account 2,33,600. One total 3,33,600. Then minority interest as given in the, as we have calculated, 1,39,900. Then non-current liabilities, we have 6% debentures, 6% debentures, 6% debentures. See here, 40,000. From that intercompany, there is adjustment. In one adjustment, it is given intercompany. It is not given in the adjustment, but it is given here. See, this is intercompany 10,000. Here we have 40,000 debenture. From that, this 10,000 intercompany should be deducted. So we have deducted that 10,000. So 30,000. Then majority share in the interest on debentures. That is 30,000 into 6%. Total 40,000. Out of that, 10,000 is minority share. 30,000 is majority share into 6,600. Another way, total interest is 2,400 into 1 by 4 is 600. 2,400 into 3 by 4 is 1,800. This is another way of calculation. Total debenture interest is 31,800. Now we have current liabilities as given in the balance sheet. H Limited and S Limited. You can just go to the balance sheet. Just look at the problem. In the balance sheet, you have creditors of H Limited 2,94,000, S Limited 1,25,000, 4,09,000. So there is no intercompany, 4,19,000. Then proposed dividend is 60,000. 60,000. It is given in the balance sheet. See here, in the balance sheet it is given. This, not this S Limiteds, only H Limiteds we have to take. Okay. Now balance sheet total is 15,84,300. This one. Now assets, we have only few items. Asset side, asset part of the balance sheet, non-current asset and current asset. Non-current asset, we have fixed asset only. Tangible assets, H Limited, S Limited. See here in the balance sheet, it is given fixed assets 5 lakh and 4,40,000. Current asset 2,94,000, 2,87,000. We have to write both of them. See, we have written first fixed asset. In that tangible asset, as we saw now, fixed asset 5 lakh and 4,40,000, 9,40,000. Then we have intangible asset. This is goodwill, which we have calculated, and it is there in the note number 3. Note number 3. This cost of control. Its last part is 63,300. This should be the balance sheet item. That is 63,300. Note number 3. Then current asset as given in the problem, just copy and total 2,94,000 and 2,87,000, 5,81,000. Total of the balance sheet is 15,84,300. This is how we solve this problem. Hope you have understood this problem. Okay, thank you for listening to the class.